Bull or bear 2023, looking into the markets for next year and what possible opportunities we could look out for coming into the new year. Now, can you believe it? It's already the end of 2022, but we have put together a series for you, a Q4 investment strategy series, because we want to guide you together with us in your self-directed journey so that you can decide and spot where the next possible opportunity is for your investment portfolio. Once again, you're on show 3 and you're with me, your host, Olivia Higgins. As always, a pleasure to be here and to be with you as part of the discussion. Now, today's topic is a different one. Yesterday, we covered, the defensive playbook. We also covered the opportunities in China market. And today, we're going into the new APAC in the post-pandemic. Now, a lot of the questions yesterday centered around, geopolitical spaces, going post-COVID world. What are the possible trends we should be looking out for? And also, what are the particular industries that we should zoom into? Now, these are recurring questions, and I want you to keep those questions, all right, for later on, and keep asking it for our expert today because they're about to share their key insights from today. Now, I have to remind you that this is just for educational purposes. So remember to just use this as a tool to guide you. This is not advice. This is a way for us to be the bridge towards educational content for yourself so that you can make a better decision overall. So today, I would like to invite our expert from CSOP Asset Management. We've got Bruce Zhang on the line. Hi, Bruce.
Hi, Olivia. Nice to see you again.
Nice to see you again. Now you're a recurring face. You might as well be my co-star on the show.
Yeah, thanks. Thanks. You're also a star.
Yes, and I'm sure, they had a pleasure meeting you in the offline events we had for our lunch and learn networking
Yeah.
sessions. Wasn't that fun?
Yes, the fun. I think some of the prediction I realized, but the market is still under a lot of pressure, and hopefully next year there'll be more boost than bears.
Right. So the last time when we covered some insights, and we've had several shows throughout 2022, and we're already at the end of 2022, but where was our last check-in? Remember the last time when we were covering inflation and also other
Yeah.
industry trends within the region? Where are we right now?
Yeah, exactly. If you go back to 2 or 3 months ago, we are checking whether the inflation has peaked. I think if we talk about the US one, the good news that if you look back last month's release, the inflation seems has peaked a little bit, so which already boost the market sentiment. But within Singapore, it seems the inflation is still quite sticky, and that's what I'd like to discuss today.
Excellent. And that's a good check-in. We're always looking every few months where we should head towards. And we're really lucky to have you today again to share your insights as we close off the year and head into 2023. Now, I know that you've got some insights to share with us before we head into our fireside chat. Now, before you start, maybe you could just give them a little teaser of what to expect from today's show.
Yeah, sure. As I just mentioned, we are talking about the so-called new APAC in the post-pandemic. But I would like to add this why this could be a perfect timing for investors, because now since the Fed maybe still have a higher terminal rate, but this may slow the pace of the hike. So if that really happens, it definitely boosts the market sentiment. So I think investors should be prepared for this potential turnaround. I think this could boost it a lot of asset classes, including equities, REITs, and even bonds and some foreign currencies. And even for a money market fund, which may see a stable or even lower yield in the long term, but we still believe money market fund can still act as a flexible asset allocation tool for investors to in and out from the riskier assets.
Thank you for setting the context. Well, the audience, leave your questions for the end and keep asking them as always. But remember that we're also giving away some prizes throughout the entire show. So stay till the end and pay attention to what Bruce is about to share. All right, Bruce, the floor is yours.
Yeah, thanks, thanks, Olivia. So in today's presentation, I will start with a quick introduction to our firm, CSOP, and following by the economic review and outlook of the US Fed hike. And at the end, I will talk about our APAC low carbon equity strategy, S3 strategy, and also the money market fund strategy. Then we'll have the Q&A sessions and also the lucky draw sessions. So first, if we turn to page 4, who is CSOP? CSOP is actually established in Hong Kong in 2008, and our parent company is one of the largest Chinese asset management firm, with AUM at US dollar 280 billion as end of last year. And CSOP is one of the largest ETF issuers in Hong Kong and manage half of the top 10 most actively traded ETFs as of 2021 in Hong Kong. And if you turn to page 5, CSOP is also the first Chinese asset management firm expanding to Singapore and launched 3 ETFs and 1 money market fund in Singapore over the past 3 years. And moving to the next slide on page 6, as an asset management firm with a Chinese background, CSOP is dedicated to promoting renminbi internationalization. And now in Singapore, we are managing the world's largest Chinese government bond ETF with AUM around US dollar 1 billion. And on page 7, CSOP is also deeply engaged in a responsible investment. And we also recently launched an APAC low carbon equity ETF strategy. And I will also briefly introduce this strategy in a later stage. So as our audiences are in Singapore, I'll start with Singapore macro review and outlook first. And if you turn to page 9, as shown on the top left chart, the Singapore recovery is still underway, as its GDP remains quite resilient, with the latest quarter's rating actually comparable to 2018 levels and even better than the 2019 levels. And retail sales, as shown on the top right, are still strong, with a double-digit year-over-year growth. And export growth went down recently, mainly due to the high base effect last year. But in the industrial production is still in an expansionary mode. And meanwhile, on page 10, Singapore is still benefiting from a healthy domestic job market and household balance sheet, as well as the tourist population growth. As shown on the left-hand side, the Singapore jobless rate is even lower than the pre-COVID level for now. And Singapore household net asset level is actually at Sing$ 2.25 million, which is a quite impressive level. And on the right-hand side, the Singapore tourist arrivals reached 750K in September, actually a very good number on the back of just a total 5 million national population. And this population is also expected to continue to grow in the future. And also, if you turn to page 11, the Sing dollar strength should lead to a higher demand for Singapore assets as inflation yet peaked, because 2 months ago we are talking about whether they will peak or not, but now it seems the inflation still not peaked. The Singapore Central Bank, MAS, expect to remain hawkish, and this could lead to a stronger Singapore nominal effective exchange rate. And Sing SGD has actually outperformed most of these major currency peers around the globe and in the region, and only mildly depreciated versus the US dollar year to date. And after talking about Singapore, if you look beyond Singapore on page 13, like 3 months ago, we believe the elevated inflation, the potential recession risk, and current monetary tightening still remains the 3 major risks in the global economy. But the Fed's pace may be slower in December, and I'll discuss this later because we have another important economy to discuss. And if we jump to page 17 for China, on page 17, as compared to global peers, we still believe there are 3 key opportunities in China. So which is namely the stimulus and the policy and also the reopening. As for stimulus, it's more about Chinese still have some room to stimulate to speed its recovery from the lockdowns. For example, the most recent, the triple R cut. And for policy wise, we do see a more policy clarity after the 20th National Congress of the CPC. And in terms of reopening, I know there are a lot of discussions around this, but we have to say the COVID policy has seen some signals of relaxation even before the party's Congress. And now we are pending more clarity, more updates from the party in recent days. I also discussed this a little bit in a later stage. And if I move to the page 18, after the 20th Party Congress, we believe the high quality development remains a high priority. I think this reassure the market confidence, and development as a keyword in Chinese, we always love to search for such keywords, is still mentioned most frequently during the Congress. And also, in order to double the 2020 GDP by 2035, the implied Chinese annual GDP growth should be around 4.5% in the next 13 years. So this means China still needs to do a lot to support this growth. And also, the party insists on the high level of opening and support and guide the development of the private sector, which are all positive to the market sentiment. And move to the page 19. Specific to some key sectors, the technology is still one of the sectors key to the national security. Thus, the party targets to establish a globally competitive and open ecosystem of innovation, but emphasized on self-reliance and supply chain security. While there was no specific mention of the Chinese property downturn, the housing is for living, not for speculation, was also not mentioned in the opening speech. As this means the continued downward pressure in the property sector expected to trigger more piecemeal easing measures, which should be positive for the sector. And as for the renminbi outlook on page 20, assuming that China will see a moderate growth rebound on the back of a low base, we still believe renminbi may appreciate modestly against the US dollar in 2023. This means renminbi may be stronger versus US dollar, but slightly weaker against the other major peers other than the US dollar. There are three major factors to decide this moderate appreciation. The first one is the trade cushion in China may be diminishing because the global growth tends to be slower next year, and China's supply or production supply chain may not be fully recovered. So from this perspective, this may put some pressure on the cross-border flows, and also thus the renminbi's valuation against other currencies. And also, it's about the relaxation in COVID-19 policies. I think, in fact, this expectation could, for the further loosening, could encourage a comeback of the foreign equity inflows. But the elevated uncertainties on the timeline or the back and forth may introduce some volatility to these flows. So also it will impact the potential renminbi's rebound versus the US dollar. And the third angle is that China may still likely to keep a relatively low interest rate to reduce the contingent risks from the property market. And this means that China's negative yield spread with the US will take time to fully close. And if we move to page 22, since we mentioned about the China-US spread, I think it's a good time to recheck the Fed rate hike path. As shown on the top left chart, the US inflation is still at a relatively high level. But if US CPI continues to slow from the peak, like what have we seen recently, and as indicated by the US 10-year inflation break-even on the top right, then interest rates are expected to peak soon. And these implications are a lower US yield with a sooner than expected peak of the terminal rate in 2023. And if you turn to the page 23, well, potential slower pace of the hike boosts the risk appetite, such as equity and bonds. The robust services inflation keeps alive. So that is a threat that inflation expectations will become unwarranted, which would still justify a higher terminal rate, even the pace can be slower. And consensus estimates is for the Fed to raise the rates by 50 bips at its December meeting. But this may not alter the Fed's terminal rate of around 5%. So from this perspective, the defensively positioned money market fund may still see some higher yield. And even when the Fed, let's say, finally stops and turns in late 2023 or 2024, a dollar money market fund could still enjoy a relatively high yield for a longer period before that really happens. So after briefly talking about the market outlook, I'd like to talk about our recently launched APAC low carbon equity ETF on page 25. Actually, it combined both the APAC equity and the low carbon themes. First, it captures the APAC growth story as the APAC region still delivers the highest growth rate, over 4% per annum in the next couple of years in the world. And this could help diversify the risk. And moreover, it grabs the theme of transitioning to a low carbon economy. So to briefly talk about what is low carbon on page 26, a low carbon economy is an economy based on energy sources that produce low levels of the greenhouse gas emission. And carbon neutrality means that any carbon dioxide or greenhouse gas emissions released into the atmosphere from whether country, company, product, or individual's activities is offset by an equivalent amount being removed from the atmosphere to realize the so-called net zero. So on the back of this spirit, if turn to page 27, we worked closely with the index vendor, FTSE Russell, to create a benchmark for our strategy. And the index method, in simple words, is that the companies with less fossil fuel reserves and less operational carbon emissions will have higher index weights. And those companies with business activities of controversial weapons, tobacco, thermal coal, and some UN Global Compact controversies are simply excluded. So regardless how high the score is, we want to include those names. And the good news is that the backtesting shows it had at a better performance versus a cap-weighted index in the APAC investment universe. And more importantly, on page 28, from a timing-wise, which echo our topic today, it may be a good time now to invest in Asia-Pacific equity, as its valuation is lower than its historical average, and also much lower than its US stock peers. And also echo my outlook in my previous slides, if the Fed slows the pace of hike, APAC equity will tend to rebound quickly, just as we have seen a few weeks ago. And after talking about the APAC low carbon strategy, another interesting strategy and the current environment is the S-REIT on page 30. So like the Asia Pacific equities, the S-REITs recently also rebound sharply thanks to a potential slower pace of the hikes from the Fed aimed at lower than expected US CPI. And the S-REIT's third quarter earnings also showed a mixed to positive results, which should also support S-REITs from a fundamentals perspective. And looking into the 2023, we still constructive on S-REIT outlook because our ETF's benchmark, the AIH S-REIT Leader Index, is expected to deliver over 6% dividend yield next year, so which is quite impressive and also higher than the Singapore's core inflation. And specific to some key sectors, for example, the industrial sector, REIT sectors, we believe the investment are to still support the long-term demand. And the warehouse rents could be within these industries could be growing faster than the factory rents. on the one hand, because of the industrial demand, on the other hand, is because of the limited warehouse supply to see the strong growth in rents. So the COVID impact also has some positive impact on the supply side. And similarly to for office rates, we believe the office demand will be driven by the technology and financial non-bank, particularly non-bank financial services. So even some traditional sectors such as commercial banks leave the CBD area. There's some newcomers such as wealth management firms and also the fintech firms. And office supply. Since the office supply is expected to be less than the last 10-year average, this will support the office rents from a supply side, like the industrial rates. And also the good news is the physical occupancy returning to pre-COVID levels in the early 2020. And now that's why I also present this in my office instead of my bedroom. And also on the back of this, the grade A rents, we believe it will be grow at a larger than 8% speed for this year and continue to grow in the next 2 years. And as for retail rents, we also constructive on retail because retail rents are already bottoming out as the demand and supply gets into balance. And the limited supply plus the return of tourists, as everyone can see in Singapore, will drive the rents higher in the next couple of years. And these are return of the visitor arrivals has already supported the strong retail sales. And now, as I mentioned, the retail sales growth remains at the double-digit growth, and the whole year retail sales value is expected to be even higher than the 2019 level, which is before the COVID period. And for data center, it's more about structural tailwinds such as 5G and cloud computing, but more importantly, it's about the hotel rates because it's quite sensitive about the current cycle. And we already seeing a sharp rebound in the visitor arrivals due to relaxation of the COVID rules and the resumption of the business activities. We also expect a large conference and meeting events in Singapore will attract more visitors to the country. And obviously, the hospitality will benefiting from this, with its revenue per available room per month already surged to the all-time high, which is a quite encouraging numbers. And valuation-wise, if you move to page 31, well, from a spread perspective, the S-REIT yield spread versus a risk-free yield is still below its average because the risk-free REIT is still at a high level. We must note that the price to book level, as shown on the top right, it's at a deep discount. So even considering the most recent rebound, its PB level is still just about 0.9, which means there are around 10% discount versus 1 level. So from this perspective, it's really attractive. And also on the back of still high inflation, the S-REIT yield, more than 6%, can still outperform its core inflation, which is 5 plus something. It's if we compare to the peer rates across the globe, Singapore is among the few countries which can still use this yield to outperform its core inflation. So it's quite important at the current stage. And page 32, it's a snapshot of our CSOP S-REIT ETF. The AUM now it's more than SGD 90 million, and its investment objective is quite straightforward. Just fully replicate some large and mid-cap S-REITs listed on SGX exchange, and we do provide a SGD trading options SRT and also the SRU, which is for the US dollar counter. And the ticket size is quite small, which means in theory, investors can trade as low as 1 unit, which is slightly less than 1 Sing dollar. So it's quite a convenient ones. And also for the dividend, I think investors care a lot about the dividends because now investors need a dividend to outperform their inflation. I would highlight for this strategy, it pays dividends every 6 months. The last one, it's paid in August. The yield is around 5.6%, and the next dividend will be announced in January and paid roughly in February. And in line with the current market environment, this dividend yield will be around 6%. And also from a fee perspective, the fees are management fees around 50 bips and will be capped at 60 bips. So lastly, on page 34, it's our Singapore domiciled US dollar money fund. As we have been discussing this from time to time. And as of now, thanks to everyone's support, now it's AUM, it's 130, over 130 million. And the minimum creation redemption size for this fund, it's just it's US dollar 100. So it's also quite reasonable ticket size, and yield, it's much higher than we first present this. I still remember when I first presented this with Olivia, this yield is just about 2%, and back to one or 2 months ago, this fund's yield is 2.5 something, but now it's already 3.6%, which can also be found in the Moomoo's app. So if we turn to the last page, I still want to highlight again on these funds as key characters on page 35. Namely its safety, the low cost, and diversification, and particularly the competitive return, net yield more than 3.5% with a T0 arrangement on Moomoo, which means it acts like a demand deposit, but with much higher interest, and sometimes even higher than 1 year fixed deposit, but can still capture the trend of current rising rate environment with the creation redemption flexibility. So I'll pause here to welcome more questions from Olivia and the audiences.
Oh, thank you so much, Bruce, for covering your key insights. Now, that was very comprehensive as always. It's really about your perspective and your expert analysis on this. And the audience have already come in with their questions. And of course, we'll leave that till the end because we want to proceed on with some further questions I have from your presentation. Now, you talked about the recovery of Singapore being underway. Now, may I ask, what could be the most promising asset in your opinion?
Okay, maybe we can do a simple scenario assumption. So given that inflation is still a bit sticky, in particularly in Singapore, so in the near term, it is likely to enter two potential scenarios. And the first one is that growth remains on track, like now, but inflation is still high. Then historically, when we have similar scenarios, the equity performs the best in Singapore as their improved earnings could overwhelm high inflation and high interest rates. And these performance is followed by the S rates. And but Singapore bonds may struggle at that time as bond prices will be compressed by the higher interest rate and high inflation. And the second scenario is that growth becomes slower on the back of the global slowdown, but inflation remains high, something like a stagflation. Then the historical experience told us that the S rates was the best performer as its relatively long weighted average lease expiry with an increasing rent term provides a cushion versus the high inflation, and its diversified debt maturity also help diversify the interest rate risk.
Right. So, you mentioned the S REITs, right? It's been under pressure for quite a long time. So, for the first quarter of 2023, could there be a turning point for this?
Yeah, it is true. S-REIT has been under pressure this year, but it's also worth noting that this year actually it outperformed the U.S. Treasury bonds, or even U.S. inflation-linked bonds, and also the U.S. stock and Hong Kong stocks in the U.S. dollar terms. And this is because as compared to bonds, REITs have growth features embedded, which could help cushion the rising inflation interest rate impact. And as compared to equities, REITs relies more on rental growth, which is relatively stable. So they tend to have a lower volatility versus the equities. And specific to S-REITs, it also benefits from Sing dollar strength and strong corporate governance because, for example, around 70% of our underlying REITs have a government-linked sponsors. And as for the timing, I think if the Fed finally stops, let's say sometime in the first quarter, then obviously it will boost the S-REIT performance because over the past 10 to 12 years, the S-REIT maximum drawdown is around 20 to 22%. At end of October, before the most recent rebound, its drawdown is already close to 18 to 19%, which means the upside opportunity is way above more than the downside risk.
Yes, and good point that because people are already asking, where is the turning point for this? Where's the turning point for that? I mean, we don't have that crystal ball. I wish we did, but I think, it's important to look at the current data and then sort of make several scenarios and, play out and adapt our portfolios accordingly. So what happens if the last rate hike stops next year? Now, any risk we should pay attention to, Bruce?
Yeah, to be honest, we still don't know the exact date when the Fed will finally stop. But let's assume that the Fed stops sometime, let's say next year. Let's assume a what-if scenario. These would obviously benefit most asset classes, include the stocks, bond, and REITs. And the rationale is quite straightforward. Because the lower interest rates could support or even the expectations could support the market sentiment, and it will translate into a higher security prices due to the lower discount rates. And fundamentally, it also helps, taking REITs as an example again, if the interest rate peaked and even start to be lower, it will help REITs to gradually lower the funding cost and manage their leverage in a more flexible way. Thus, they have more rooms to use the funding to conduct the asset enhancement initiatives or even make more valuable acquisitions. But as you mentioned, ask the risk, right? As for risk, we must pay attention to the Fed's terminal rate. The implication here is that even the Fed may slow the pace, let's say on December 14 meetings in about 2 weeks to 50 bips per hike. The terminal rate will be anyway higher as compared to nowadays to be around, let's say, finally reach around 5%. And the inflation was slower from its peak in the recent release, but core inflation is still sticky. So the inflation reading on December 13th, which is actually 1 day before the next decision, is still important. Right. And you just as you mentioned, data is important, right? The U.S. labor market still stay resilient, which means this may not prevent. I mean, the labor market itself may not prevent the Fed from further hikes for now, if the Fed needs to do this to combat the core inflation. And let's say any strong inflation or labor market readings in the US will still raise the expectations of the Fed terminal rates. Even the pace could be slower, and this could increase the market volatility in the meantime.
So let's go into China, okay? Because we covered that yesterday as well. I do want to bring it up with you as well because I want to know your insights. Now, you said, you talked about regarding, the China currency space, and you also mentioned, their regulation, their reopening strategies, their COVID-related social restrictions. Now, what do you think of the China asset in general with regards to all those things I mentioned?
Yeah, thanks for that question. I think that's the one I want to talk about because after talking about the risk from the US, I think another potential risk or maybe opportunity is from China because China is still the second largest economy in the world. And if we talk about the COVID-related social restrictions, I think it's still the big fundamental in China. I think now the good news is that China start to test marginal reopening recently. But it takes time to achieve a full relaxation. Like other countries, including Singapore, there will be some back and forth under this process. As China, which is different from the other countries, that China has a very, very large absolute number of the aged populations with a relatively low vaccination rate. So from this perspective, a seesaw session is highly likely in the next couple of months as the country needs to the country leaders needs to ensure the reopening will not directly threaten their people's life, particularly the elderly people. So if China gradually reopens, it could obviously boost its stock market as valuation is quite low, and the regulation crackdown that the negative is pretty much over at current stage, and funding environment is also not expensive. So that's why we still, if they finally opens, we still positive on their risky assets. And in terms of renminbi, could also be supported, we believe, due to a more promising domestic growth. And one live example actually is when China reduced the quarantine time from 7+3 to 5+3, maybe around 2 weeks ago, 3 weeks ago, Chinese stocks and renminbi already surged.
Thank you for sharing that, because you also cover that and touched slightly on your presentation. But then, of course, now you've given a summary and also an all-rounded extension point related to that. Just another extender, and also because we're already getting questions on this. Whatever happened in the last few days in China, do you have any comments on that with regards to the markets?
Yeah, it seems I already know what you're asking.
Yeah.
Yeah. I have to say again, I highlight from time to time. I'm a portfolio manager, not a, let's say, political experts. But I have to say, the fundamental or the core of the China's long-term stability or development is based on its economic growth, and China as a nation, or the party as a governance party, they has been doing this very successfully since, let's say, 1980, means more than 40 years, to boost the economy and boost the demand, domestic demand, raise the people's living standard. I think the newly elected leadership will definitely insist on the same target, and so there's no way to step back, or to compromise this target. And one example is that if you look at the Chinese GDP per capita, for nowadays, now in the recent years, it's already 12,000 nominal US dollar per person per capita. This is just around the world average, and that's compared to South Korea. It's just about the level that South Korea has 20 years ago, which means to continue to increase the GDP and GDP per capita could resolve a lot of problems for now. And also, the reopening is more about the recovery of the economy, because now I have to say the fiscal policy quite supportive. A lot of projects on its way, and the monetary policy is also supportive. The interest rate getting lower, funding environment is quite friendly. So the only trigger, or the only major trigger, is about the reopening, and everyone in and outside China have a very high expectation for this reopening. I think if reopening could last even on a gradual pace, because it's quite reasonable to test and try and error. Sometimes you reopen, there will be maybe increasing cases, or even some cases in the ICU, or indirectly lead to death. But there was always it takes time for this reopening. But if we keep this direction, then obviously the market sentiment will gradually turn.
Good point there, and some points that I can also perhaps tell some of the discussions I'm having with my friends later on in discussion tables, because that seems to be the topic at the moment. Thank you, Bruce, for that. Okay, to summarize our fireside chat, among equity, bonds, MMFs, what will you prefer most within these spaces? Because the questions already coming in are about allocation, and how much should I be putting in this, and should I be adjusting for 2023? What are your insights on that, Bruce?
Okay, if I answer this question from a portfolio manager perspective, obviously I'll propose my bonds and money market funds, as my focus is more on these areas. But from an asset allocation perspective, I do suggest investors be ready to return to equity, including REITs, as if the Fed releases some signals of slower hike, or a more clear terminal rate, let's say they said, oh, the terminal rate will be 5 or something, it will imply that inflation may return to the Fed's comfort zone, and the economic growth in the US cannot weather further tightening. And if that really happens, the investors should move in advance to capture the rebound before the Fed actually stops. And this is also true to bonds, as a lower yield in the future will boost bond price and help other countries' FX, particularly the emerging market currencies, including the Chinese renminbi bond market. And in the meantime, as I mentioned before, the dollar money market fund may not lose its attractiveness. On the one hand, the MMF could lock some higher yielding investment for a longer period before the interest rate becomes lower. And on the other hand, even in the long term, money market fund may not always see yield increasing like nowadays. It still provides a higher yield versus the demand deposit and provides a T0 flexibility for investors' money allocation. So like our fund on Mumu's Cash Plus platform.
Thank you, Bruce, for even just summarizing that for us. We will have more insights on this later on. So to the audience, please wait and keep coming in with your questions. Now, Bruce, I'll be back with you very shortly because we're about to do our first giveaway.
Okay.
Soon. So to everyone watching, to reward you for being here with us, we always want to keep you in the interaction and make sure that you have been taking your notes, you've been paying attention. And so we're going to go into our first quiz giveaway, all right? So this is how it works. We'll have the 5 right answers and also the fastest fingers first to answer the question. You'll stand a chance to win some rewards from us. So this is the mechanics. And please make sure that you answer it correctly because you only got one try and you've got to be fast. Are you ready? In 3, 2, 1. The first question is, the next Fed's meeting will be in A, first quarter of 2023, or B, second quarter of 2023. Bruce was highlighting this in his presentation. You guys are very, very quick.
Quicker than myself.
Me too. Okay. Amazing. Congratulations to all the winners. The correct answer is, of course, A. Congratulations. The team will be in touch with you. Okay, so before we go into the Q&A, we've already picked out some of the best questions that we'd like to ask Bruce. And before we invite him back onto the floor, I would like to just quickly cover how you can apply what you just learned from today. Okay, so it's not enough to just learn the insights. You've got to learn how to at least apply it and figure out what the next steps are. So very quickly, I'm just going to show you how you can access those funds. Okay, so if you open your app right here, okay, it should look like this. Very straightforward. All you have to do is head over to this button right here on the bottom, click on Money Plus, and you'll be able to be redirected straight away in a matter of seconds to this page. All right, you click on it. And it should look like this. Okay, so if you are deciding and still figuring out what you want to go into, it doesn't matter because we've equipped all the indicators right there. We've put all the information for you. All you have to do is to decide on your own if that is the way you'd like to do it, right? So it's very straightforward. You just have to go to Cash Plus, and immediately you already see the CSOP USD Money Market Fund. And this is important because as he talked about the yield and he talks about all the other elements that go into your decision making, we provide that and we have those tools because we believe in helping you and directing you in that personal investment journey. So we provide as many tools as possible to make sure this happens. So if you click on CSOP, and for the purpose of this, of course, we're going to use CSOP Asset Management Limited. Click on that. Here are the available funds that are on the platform. And of course, right now we're talking about the USD Money Market Fund. Click on that and you get all the instruments and also the tools that you need, right? So if you see the tabs, you got the performance, very important, but you've also got the news, you've got the analysis components of that. These are updated within seconds and it's also live data. So do check it often, and you can customize it as much as you want. That's what I do. I believe in really trying to find a better strategy each time when I invest in my own personal life. But if you are interested for yourself to be a part of this fund, you can click on subscribe right below, the bright orange button right there. So you click on that, and you can proceed on with this. So the minimum is 0.01 USD right here. But in Singapore, of course, if you are living here, we've also got, promotions related to money market fund. You've got, their own indicators and their own disclaimers related to that. So that changes, and you have to check it out if you want to be in the know of everything of what you need to enjoy the different campaigns that we have on. Okay, so that is it. And I hope that was easy to follow. And if you have more questions, do contact our team members. We're here for you, and we want to guide you. Okay, so thank you for listening to that. I am actually going to go straight into quiz 2. So quiz 2, top 5 people, fastest fingers first, and the right answer, you will walk away with a gift from us. Are you ready? In 3, 2, 1, what is the currency of CSOP MMF that is onboarded on Moomoo? I hope you were listening right then. Is it A, USD, or B, Hong Kong dollars? Very, very fast. I'm sure Bruce is very happy with this.
Yeah.
Okay, we have our winners. Congratulations. The answer is A, of course, USD for CSOP MMF that is onboarded on Moomoo. Congratulations. The team will be in touch. Okay, to the most exciting part of the live shows, your questions answered. Can we invite Bruce back onto the floor, please?
I'm always here. Thanks.
You're always here.
I'm always here.
I love it. Okay,
Yeah.
so Bruce, a lot of questions for you
Wow.
as always.
Okay.
So the first question, what will happen to MMF yield if the Fed stops the rate hikes?
Yeah, I think I already touched a bit in your previous questions, but I have to say, let's suppose, right, the Fed, let's say, this is an assumption. Let's suppose by end of first quarter, let's say Fed stop at around 5%. Then it doesn't mean the money market fund yield will be stuck or even be lower immediately, because just as I mentioned, in a takeover fund as an example, the underlying has a diversified investment with various types, such as deposits, such as the bonds, such as some treasuries. There's some or CDs. They tends to have, first of all, they tends to have a if we to look about the same timing, they tends to have a higher interest rate or yield versus less the Fed rates. And they also, when we invest in such underlyings, we can manage to lock them for longer periods. So not unlike a floating notes, we can fixed or lock their yield, let's say for 6 months or to even to 1 year, which means even if the Fed stops or even lower their interest rates, the money market fund can still keep a relatively high yield for quite a long time. And this doesn't prevent the investors to leave or back into this money market fund. For example, if the Fed slows the rate hike, the investors want to rush into equities, no problem, just a T0 arrangement.
Okay, well, the next question is about economics development. So what do you think about the economics development of China under the strict zero COVID policy remaining in 2023?
Wow. I think if this if a very strict zero COVID policy remains, I think the Chinese growth may still face some pressure, because this year the whole year forecast, it's already just around 3%, which is below the implied GDP growth rate of 4.5%. But just back to my previous points, if the country or the country leader would like to achieve this blueprint to achieve a so-called basic socialism modernization in 2035, the GDP growth needs to be boosted up. I think now, just as mentioned, it's not about monetary policy, not about fiscal policy. It's about how to flexibly apply this zero COVID policy. But I think if we do see some back and forth, but we still see positive signs even in recent days, because we see the leaders can travel outside, let's say attend the G20, right? It's also a sign that there should be more opening than the more strict policies. But of course, as I mentioned, there may be some let's say some in some certain cities or certain regions, there may be some stricter policies. It really depends on how severe the spread or contagion could be after the further reopening. I think this try and error process is quite normal, because every country is experiencing this. Like in Singapore, let's say in 2020, we used to have a very strict COVID policy, but after that we relaxed, and sometimes we see a higher cases and higher ICU cases. We partially lock down again, and then we reopening again with better preparation. I think China will also experience a similar path.
Thank you for sharing that. So for the low carbon for APAC, right? Is there a fund or ETF that you would share your insights on that could promote sustainability like low carbon?
Exactly. I think it is a ETF, which means investors can trade it on exchange like stocks, using either US dollar or Sing dollar counters. But from a methodology wise, it will be rebalanced once a year, which means it will not only rebalance on its market cap, but more importantly on how good their governance could be in terms of control the carbon emission. So from this perspective, we are still quite like this strategy, because they keep a lot of growth strategies, or the hot sectors such as the technology and some consumer discretion names and some financial names. Those sectors that tends to have a lower emission as compared to the traditional energy sectors, but also benefit from the improvement, the fundamentals, and obviously benefit of a potential slower pace of the Fed hike. And this is very important, because after the last CPI, US CPI release, we saw this ETF rebound really sharply, which means on the one hand, for some investors, they have a very high standard of the ESG scores, right? They only want to invest in something that is quite green, right? But on the other hand, on the top of this, investor can still enjoy the beta rebound from investing this equity strategy, because this is the only APAC equities ETF on Singapore exchange.
Thank you for sharing that. Okay, so on the flip side, and also maybe let's start with the positives. What are some of the advantages of investing in such an ESG fund? And then maybe you can, share a little bit on the risks associated with next year as a time horizon.
Yeah. If you talk about the market, it's quite straightforward. It's about the beta rebound. But if you talk about ESG, there are a lot of benefits, because now even for the different countries' governments, they may put this carbon neutrality or lower carbon emission in their laws, which means will be obviously have some impacts on the underlying corporate investment. And also, as mentioned in my slides, is that we do see the corporates with a better carbon emission management, they did outperform over long term versus simply cap weighted strategies, because our strategies are more like tilt strategies, which means we overweight those companies with less emissions, or can reduce the emissions, but also underweight those names with relatively bad operations or relatively less lose control of their carbon emissions. So that's why the investing in ESG is not only about ethics, not only about a policy target. It can have some real impact on the long-term growth prospects of the underlying companies, and it could benefit back into your investment. I think one interesting example I can use is that for some of the property managers, they do use some let's say some green energy to apply into their, let's say, the Alcon system, I think the net result is that they will save more electricity and save more cost, and this will translate into a high profit margin and to boost their the whole revenue of their, let's say, stocks or even REITs. I think that's why we go green. We go green not simply for green. We go green for better profits and long sustainable developments.
Two sides of that pie. Thank
Yeah.
you for that. So for the CSOP USD money market fund, seems like the interest hike cycle is slowing down. So does this mean that the USD money market fund yield can still climb up?
Yeah, it's very interesting question. If you look at the Moo's yield, you will see it actually that it has a slight lag of the US hike cycle. This is because we may lock some investment before every time's hike. But the good news is that even if it slows down, since we are slightly behind the cycle, we will continue to catch up or even provide a higher yield versus the Fed rate in the longer term. So investors should still see higher yield in the next couple of months, even the Fed announced to stop or announced to slow the pace. So please expect this.
Thanks for sharing that, because I think the recurring underlying question on people's minds right now, they try to refer it back to contextual analysis. And I think the contextual analysis is the key to decide on whether, okay, which direction should I head towards? What should I do next? So with that, someone would like to know what will cause, or what are the key drivers that would cause the money market fund to have negative earnings?
Yeah, I think I used to answer this from time to time. I think if let's say an example which is very unlikely to happen is that if the underlying investment is in negative yield, obviously the money fund it's in negative yield, but it obviously is not applicable to US dollar money market fund. The yield is still quite positive. Even the Fed turns to this direction to lower the rates, they may no longer lower the risk to back to zero again. Yeah, unless some black swan event, touch wood. That's for one thing. The other potential opportunity for negative NAV is that if we see the redemption happens all at the same day. Let's say all of our underlying clients redeem on the same day, which means we have to sell all the underlying assets and mark them to market, which means the potential selling price may be out of our control. But what we would highlight here is that our money market fund client base is highly diversified, and we all know who they are, and they have a very different, they're from different industries, they have different types, they have a different investment horizon. So we are quite comfortable that they may not redeem this in one day. So that's why we are quite comfortable for our current NAV, the gradual increase of our NAV. And since inception, almost 5 months, more than 5 months now, we didn't experience any single day loss of NAV, which means the investors can only see a stable and gradually increase of their NAVs per day.
Got it. And talking about, NAV and also all the other indicators that you need to know, I covered it just now for those who also ask questions on that. So if you want to watch the replay of this, you can always watch the demo again and also watch Bruce's insights from before, especially if you just joined midway. Thank you for your question. So we've got time for about 2 more questions. The second last question, India, China, Japan equity markets. Which one do you think is most underweight, and which one do you advise to enter?
So you mean India or Japan?
I think they want to know all three, comparative analysis.
India, Japan, and sorry.
India, China, and Japan.
Wow. I think that China's maybe I start again from China. I think China's problems is that they need to reopen. I think valuation or even some specific companies' fundamental may not be a big problem for now. I think what we should wait the reopening to trigger a strong rebound. And for Japanese equity market, I think it's I also quite I think it's quite constructive for now, but it's more about Japanese yen. I think it's more about when the yen could finally rebound. I think one of the key timelines that maybe in March next year, when which is a time that maybe the new governor in the in the government in the fiscal monetary authorities, how they would manage the yen the monetary policy and yen potential appreciation prospectus. So from an equity perspective, I think it's quite okay. India a bit different is that India always has a very high growth and high inflation. I think India is more relies on not domestic ones, it's more relies on the Fed path. Yeah, so in simple words, China is more about domestic reopening. India is more about the Fed path, and for Japan, it's about their monetary policy directions.
Thank you for that. Okay, last question for seasoned investors, and I am a seasoned investor. What are some key points, if you were to drill it down to about 3 of them, that Singapore seasoned investors should look out for 2023?
Wow, seasoned investors. Yeah. Let me think about some keywords. I think first of all, maybe as mentioned on page 20, page 22 in my slides, is to be prepared to the interest to peak soon. I think that's very important. And also to seek for the investment which could beat the inflation. So it's the second part. And third part is be flexible to use money market funds to in and out.
Okay, so could you just remind me again, what was on page 22?
Page 22 is that market expect the interest rate to peak soon after recent US inflation, which means investors should be ready to this. Yeah.
Okay, so that was the summary point that you mentioned.
Page 22. I think it could be a turning point for almost all asset classes across the globe.
I think this was something similar to what you shared as well when we did our offline event, right? You sort of looked at that short-term time horizon. Okay, so I guess this question, if we were to put it into the medium term, are there any other additional points you would like to cover from that?
In the medium term, I think after the beta rebound, I think we should be more differentiated the underlying investments to then I think once the Fed turns, the first round of the rebound is more like a beta rebound, which means the ETF or the asset allocation will play the more important role. But after that, then investors will go back to fundamentals to see the previous interest hike, how they would impact in the cost of different industries differently. Then at that time, I think it's more about to do a picking. But this picking is not means we should give up ETF. We should more focus on some theme ETF with some themes, or ETF with let's say smart beta, or even some let's say liquidity weighted index to capture the sector rotation for that time.
Well, thank you so much, Bruce, for answering all the questions. We had a very good mix today of different types of questions, and the audience, it's always nice to have you as part of the discussion.
Thanks.
Now, Bruce, final thoughts before we end the show. My favorite question of all.
Okay, final question.
So, Bruce, what is that one takeaway that you'd like to leave in their heads as they go into the new year to the audience?
Okay, be ready for rebound.
Very, very succinct. Could you just expand just slightly on that?
Yes, means that investors cannot it should not. Yes, sometimes I know because recent months, I know some investors, they including some wealthy investors, they tends to put their money into the fixed deposit, which can have a very, very high yield for now. It's good and safe, but I think we should be investors should be ready because for the potential rebound. Let's say if you lock your money for 1 year till end of 2023, yes, you may get 5% or 4 or 5% of the fixed yield, but you may miss a very large rebound. That's why investors should be ready, which means investors should always be ready for the rebound, place their money to a more riskier assets. But in the meantime, they can put their money to a more flexible money market funds for the further rebound.
All right. So in Bruce's words, be ready for rebound. It's portfolio manager of CSOP Asset Management, Bruce Zhang, everyone who joined us today. Thank you so much, Bruce, and we'll see you for the next show.
Thanks.
Thank you. So our last giveaway for today, everyone, to reward you for being here with us. I hope you're ready. And if you didn't win just now, it's okay. Try again right now. The top 5 winners with the fastest fingers first. And you've got to get it right. You stand a chance to win some giveaways from us. Are you ready for question 3? In 3, 2, 1. What is the new investment trend of APAC that CSOP mentioned earlier? A, low carbon, B, environmental friendly, or C, oil and gas? What do you think? We talked about it during Q&A. Okay, congratulations to our winners. The correct answer was A, low carbon. Congratulations. The team will be in touch. All right, we've come to the end of show 3 for Bull Bear 2023. For those who didn't know, we did cover and zoom into the APAC region today, the new APAC in post-pandemic. If you want to watch the replay of this and also, kind of recap of whatever we shared just now, we've got the replays both in-app and our YouTube live. So stay tuned on Mumu TV so that you can find out more information about this. Now, if you want to connect and follow us, you've got a QR code right here. Now, this is important because it's so much information every day. We've got new content every single day for you. So we're guiding you. We're crafting all these shows because we listen to what you want. And therefore, we invite these experts on the show so that we can be that bridge for everyone. And also if you're very interested in fun content, the next slide, we've got, a series of social media channels you can follow as well. These are where the main shows are. If you're interested, you can scan the QR code because you do want to be in the know of everything. And because things are coming out so quick, there's so much educational content for you. It's important that you follow us and stay up to date with when we go live and what to look out for, especially for rewards and also financial literacy components that are very important, especially during these times. And of course, my favorite right now, you've got the World Cup happening, and this is the current campaign that we are pushing out. But at the same time, it's not just about the World Cup, it's also about inflationary measures. And during these times of rising rates, it's important that we guide you and also help you be a part of fighting the battle against inflation. So check out this particular one. And I think, some of you might really enjoy what we have to offer. So as usual, it's nice to always have everyone on the show. The next show we're having will take place in about 15 minutes. So I'll see you back here for show number 4 for selective investment opportunities in volatile times ahead. Now, these are all related topics. You have to know each show, if you want to really add value to different parts of your investment strategy, to paint that wholesome picture for yourself and to keep learning together. So I'll see you for the next show, everyone. Stay tuned and also follow our socials if you want to know where to click for the live. I'll see you later on. Signing off, I'm Olivia Higgins. Hello. Has it ended yet?